Strategies of the banks and financial institutions, some of which exploded, some of which died, and why they did, and some of which survived and are stable and are still with us. So we're going to look at the strategies of the winners and losers and get an understanding of how we got into this mess and how we're getting out of it. So let's look at where we are now in the economy and kind of survey where things are compared to where they were. Right now in the United States, the unemployment rate is 6.7%. That's an increase of about 500,000 in the month of November, 533,000 new unemployed people. That brings us to 10.3 million unemployed people in the United States. To give you a contrast, in 2007, the unemployment rate was 4.6%. Now, in Europe, the Eurozone, the October unemployment rate was 7.5%, 7.7%, and countries like France, the unemployment rate is 8.5%. In the United States as a whole, our gross domestic product is nearly $14 trillion, $13.78 trillion. And last year it grew 2%. It's almost $46,000 a person. But the National Bureau of Economic Research, which is the official decider of whether we're in a recession or not, decided that we entered a recession in December of 2007 and called it that we are now in a recession. So what happened? How did we go from growth and prosperity suddenly into very substantial unemployment and contraction? Basically what happened is our credit bubble burst. The credit bubble started bursting in 2006 and really burst finally in 2007. Housing is what led our economy up the last few years, housing and the debt associated with housing, and housing has brought us back down. Sales of new houses, for example, were at, construction of new houses was at 2 million, rate of 2 million, is now currently at a rate of 600,000. And what fueled this growth was debt. Normally, liabilities represent about 18% of net worth in this country, and it went from 18% to 26% between 2002 and current time. So it was the rapid expansion in credit that fueled the American growth the last few years in the consumer, the business, and in government. House prices went up 20% on average from 97 to 05, many much more than that in fast-growing places like Florida, California, New York City, Washington, D.C., Boston. Many grew more than 100%. Now, this year alone, they're down 20% and down 25% from the peak in June of 2006. The stock market is down. Everyone knows that. The Dow is down from a peak of 13,009 to about 8,500 today. That's down 40%. The global market as a whole is off 40%, and emerging markets are off 60%. But if you look back 3 years, it's 9%. If you look back 5 years, it's about flat. So we're kind of back where we were, essentially. Through the actions of the Federal Reserve to infuse liquidity into the economy, the Treasury bond, the 10-year bond, is down from 4.25% to 2%. The 2-year is down from 3% to less than 1%. Oil cracked finally from $147 a barrel, stunningly down to $38. A Fed funds rate, which was 4.25% a year ago, is now targeted at 0 to 0.25%. Prime is down to 3.25%. And interestingly, the 30-year mortgage rate right now is about 5.25%. That's for a conforming mortgage, a mortgage that is insured by Fannie Mae or essentially the government. The jumbo mortgages are at 6.8%. So you can see the big difference between an insured and an uninsured, and that's due a lot to the direct action of the Federal Reserve to buy the securities of Fannie Mae and the other quasi-governmental entities, now really governmental entities, that insure mortgages. And let's also talk about the car business, which, of course, there's been a lot of news about the car companies falling apart. And car sales are down from an annual rate of 15, 16 million now to 10 million. Overall, the consumer and construction as a part of the economy was up to over 75%, 76.5% of the economy was related to consumer spending or residential construction spending, and that's at least 3% above the normal rate for that. So where are we going now? I had a chance to look at some of the economic forecasts and people I respect in the industry, and I also myself worked as an economist previously. And so let's take a look at where we are, where we're going. Certainly we're in a recession, and a recession, they call it negative growth. Negative growth is a nice way of saying contraction. And you're looking at about a 2% overall negative growth for next year, but right now you're looking at numbers on a quarterly basis at 5 or 6% negative. But there are some plus side, and one other thing on the negative side, unemployment rate will continue to rise and is generally forecast to end up at around 9%. So that's a very harsh reality for people. I tell people that if someone else is unemployed, they call it a recession. If you're unemployed, it's a depression. So for many people, it's depression. So how do we get out of that? And is there any good news? And there is quite a bit of good news. First of all, you see the oil prices have fallen and food prices have fallen. Oil prices going down means less imports into the United States, less of a trade gap, and that acts as a stimulus to the United States. Food prices going down, inflation going down is also positive, and a massive reduction in interest rates lowers the price of money, lowers borrowing costs, and makes it easier for anyone with a variable rate loan to pay. So those are some positives. We also have already had a few tax cuts. There's a tax credit now for buying a new home. There's no tax if you have to sell your home at a loss, and there used to be a tax on forgiveness of the debt. Now there is not. And more importantly, there's basically a coordinated government response where the Federal Reserve and the Treasury and governments around the world are working together to stimulate the economy.